All right, everyone. Thanks for joining me tonight as we go through our webinar on selling your practice. For those of you who just joined, there's a Q&A function in the webinar. So as we're going through, go ahead and type your questions right into it. And at the end, I'll go through and do my best to answer the questions that are presented. So again, my name is Trevor Anderson. I am the managing partner of the Anderson firm. I'm also the chair of the healthcare department. And tonight we're going to walk through 5 different ways to maximize your sale price. All right, so this is healthcare specific. Some of this applies to any business, but really it's going to be geared towards healthcare professionals and those in the industry. All right, so just a quick refresher. Our firm, we've got a couple locations here in New Jersey. We practice in New Jersey and New York. We have 4 core industries that we work in, healthcare being one of the primary ones, but we also do work in cannabis, commercial lending, and debt and equity funds. And we offer a range of corporate, transactional, and compliance services in all of them. So if you have questions that extend beyond the realm of healthcare, feel free to reach out as well. All right, quick overview of what we're going to tackle today. First couple of slides, we're going to go through some market data and trends. We're going to look at M&A activity in the healthcare space over the last couple of years, see if we can identify any trends as we move into Q4 of 2024 and into 2025. We're also going to do a quick rundown of valuation methods and methodologies. So some of this may be familiar to a few of you. Some of you may be hearing this for the first time. It's always great information to get a bit of a refresher. So after that, we're going to move into the actual steps for maximizing your sale price. It's broken up into know the market, enhancing your documentation, controls, and reporting, resolving compliance and legal risks, improve margins. I know that sounds simple, but we'll get into a bit more detail. And then defining your post-transaction success criteria. All right, let's take a look here. M&A in the healthcare space has been growing significantly over the last 2 decades. You can see in 2012, there were only about 75 announced deals in healthcare, and a lot of those were strategic buyers versus PE or financial buyers. I'll explain the difference between the two here in a second, but fast forward about 10 years and you get to 2021 and you have 484 deals. 2022, you have 600 deals. There's a bit of a slowdown in 2023 with about 418 deals. A lot of that has to do with the fact that there's high interest rates out there. So private equity funds and companies have been sitting on the sidelines a bit, trying to wait out the rates. I'm sure a lot of you have heard that there's a lot of dry powder in the industry, and that's essentially what that means is it's committed funds or committed money to private equity funds that is ready to be deployed. It just hasn't been yet. So we expect 2025 to be a bit of a perfect storm, hopefully a slight reduction in interest rates, along with all this dry powder. Could be a very exciting time for acquisitions. And certainly 2026 is going to be the same, if not better. If we look at the mix, right, the sector mix and buyer mix so far, at least in 2023 and the beginning of 2024, you have physician groups leading the charge, representing 42% of the deals. Behind that, you have post-acute care, health systems, so those would be large hospital systems, and then healthcare adjacent things like healthcare IT and digital assets. But by far and away, physician groups, physician-owned facilities are representing the largest portion of transactions, and we expect that trend to continue far into the future. Buyer mix, right? Who's buying these practices? Well, we split it up into 2 groups. One we call financial or PE, and that's private equity-backed funds that are buying practices with the intent of turning them around and selling them in 5 to 7 years after acquisition for a profit. The other is what we call strategic, and that would be health groups like Summit, Barnabas, Tenet, if you're out in Texas, things like that, that are acquiring practices and facilities really as add-on to their existing healthcare system, to give them incremental either services, incremental increase in capabilities or skill sets, or just access to more patients. So strategic acquisitions were about 3-to-1 in terms of our financial and private equity acquisitions. And again, a lot of that has to do with the interest rate world that we're living in. We expect this to even out in terms of proportions over the next 2 years as private equity gets off the sidelines and actually gets into the action a bit more. All right, valuation methodologies. This is essential to understanding the value of your practice. If you don't understand the methodology that buyers are going to use to value your practice, then you are at a disadvantage when it comes to negotiating on your behalf. And there's 4 primary valuation methodologies that can be used. We'll walk through them each, but one is used more often than others. But starting with the first one, we've got discounted cash flow. That's a financial calculation, essentially, where they look at free cash flow of your practice this year and into the future and use a discount rate to discount those cash flows to present value. It can be a very complicated calculation. Usually it's going to be a private equity fund or other financial player that uses that methodology. But again, it's not deployed all that often. Benchmark valuation. That's where you can look to the market and try to find a sale of a similar business, right? Similar facility in terms of geography, patient mix, payer mix, number of physicians or practitioners in it. That is very difficult in the healthcare space. Healthcare industry is very fragmented. And so using an example transaction to set the value of your own is really going to be complicated and put a lot of risk actually on both parties. So that's rarely used. Asset and balance sheet valuations, that's looking at the book value of your practice. Again, rarely used because professional services companies like healthcare businesses are usually asset light. That may change if we're talking about, let's say, a diagnostic imaging center that has a significant amount of expensive capital equipment. In that case, you may look at the asset or balance sheet methodology, and you may yield better results than some of these other methods. The last one that we're going to talk about, multiple of EBITDA. This is by far and away the most prevalent valuation method used when acquiring a healthcare practice or facility. All right. What is that? We're going to break it down. EBITDA specifically means earnings before interest, taxes, depreciation, and amortization. Okay. Simply put, that is free cash flow, right? That is your net profit generated from business activities. It gets a little more nuanced in there, but I think that's a quick and dirty way to understand this financial metric. Is it's your net profits when you're looking at your P&L statement. Okay. And essentially what they do is they look at that and apply a multiple to that, 5x, 6x, 7x, whatever it is. And that becomes the sale price or the purchase price of your practice or facility. Okay. I want to just talk about this a little bit more because there's 3 different types of EBITDA, and it's really critical that you know the differences between the 3. Okay. One is called a historical look, and that's where they'll look at the last 12 months of your P&L and use that exact number to calculate how profitable your practice is and apply a multiple to that. Okay. That is perhaps the worst way of doing it. It yields high multiples, but it doesn't capture the actual cash flow very effectively. So a lot of times as the seller, that's not what you want them to use. The other one is called a normalized or adjusted EBITDA, and that's where they look at past performance right? Those past metrics, and they remove one-off items, right? Whether it's revenue or expenses, things that were incurred, but not part of normal practice operations. Maybe you had a large legal bill, right, in the last 12 months. Well, that's a one-off. It would be removed from your P&L, and that money would be added back in the calculation of EBITDA. Same thing, let's say you had a CT machine that you sold and you didn't replace it, and so you had an influx of cash that came in. That would be a one-off transaction that increased your income that would most likely be removed in a normalized EBITDA. And that obviously would impact that number as well. Projected EBITDA is the third form. It's a little less common, and that's where they actually project out the next 12 months of cash flow and apply the multiple to that. Sometimes you can negotiate for a projected EBITDA if, let's say, you recently acquired a new location, right? And you're expecting a big influx of patients and reimbursements as a result of that, that's not reflected in your last 12 months statements, right? Or let's say that you just became in-network, right? With a payer that has no other in-network providers in your area, right? You're going to expect a huge influx of patients as a result of that will drive up your revenues. And so you'd want that calculated in your EBITDA. I always end up fielding a lot of questions around EBITDA because it is a bit complicated. And we're going to go into some details about this valuation methodology and why it is so important to focus on obtaining the highest multiple that you can, and obviously having the best EBITDA by the time you get to the market when you're looking to sell. All right. Step one, we're just going to jump into this with some examples. Know your market. All right, let's put these things to test. So from here on out, we're going to be talking exclusively about the EBITDA valuation methodology. So you can kind of forget about the other three, at least for the purposes of this presentation. All right, this graph shows a range of different healthcare industries and types of groups, and the bars, the different colors, are the different multiples obtained as a result of EBITDA, right? So you can take a look at this, but we're really going to key in on one in particular, and that is physician medical groups, right? So that's essentially a single practice that can be a multidisciplinary practice. It could be a practice that has, an orthopedic practice that has 10 orthos in it, right? All physician medical groups. In here, we have this split up. So EBITDA for $1 to $3 million. So that's net profit. Your average multiple on EBITDA that you're going to see is 5.8. Okay. As your EBITDA goes up, so too does your multiple. You can see the next tranche, which is 3 to 5 million, has a higher multiple of 7.7. And then an EBITDA of 5 to 10 million, you'll fetch a multiple on average of 8.9. The reason why the multiple goes up as EBITDA goes up is because they're able to achieve economies of scale with larger practices, with higher revenues, and recognize better profits as a result of that. So they're willing to pay a higher multiple for them. Keep that in mind, right? This is physician medical groups, okay? Look at these numbers. These are based on 2023 numbers, reported transactions, so they're real numbers. These aren't examples. This is what's been reported across the industry to various different publications and consulting groups. And so this is a good benchmark for you to look at if you're thinking about entering the market to sell. All right. The other group, there's two other groups I want to focus on. The next one is ambulatory surgical centers, or ASCs. Here we also have pretty good data on this because it's been a hot spot for acquisitions. In recent years, there's actually been a move of bringing higher acuity procedures into surgical centers, and that's been driving up the multiple. It's also coinciding with a cut in reimbursements for procedures that are happening inpatient or at hospital settings, right? Insurance companies have been reducing those reimbursements, trying to encourage patients to obtain those procedures in ASCs or outpatient settings. So that combination of higher acuity procedures occurring there and the cut in reimbursements in the hospital facility is driving up multiples in the ASCs. Let's take a quick look at the graph here, though. You can see from 2017 to 2023, there's been a relatively steady increase in the multiple across the bottom percent quartile, the middle, and the top quartile. You can see 2020 was a bit of an anomaly, especially for the higher those higher in the range, seeing a 9.7x multiple. The numbers came back down to reality a little bit in 2021, 22, and 23. That was really driven by COVID and some of the government programs around that, because ASCs were actually allowed to perform in a lot of different jurisdictions, while some hospitals had a lot of their capabilities hamstrung by the different COVID laws and restrictions that were put in place. But as you can see, multiples going up. We expect that to continue into the next 2 or 3 years, especially as I was saying earlier, when private equity gets into the market again. ASCs have been a darling for the private equity industry, because they've been able to basically build systems around ASCs and start buying physician medical groups in that geographic area and consolidate them. So it's a great play for them. And something to keep in mind if you own a facility, run a facility, or are a shareholder in a facility, is keeping an eye out on this information and knowing where these benchmark multiples are, so that when you go to market and have these conversations, you're not sort of convinced into a lower multiple. All right, last facility I want to touch on is for diagnostic imaging facilities. The reason why I want to touch on this is because there's been some consolidation that's happening in this industry. It's slowed over the last 2 years because it's facing a bit of headwind in a couple of different areas. So most diagnostic imaging facilities are single modality imaging providers, mom and pop shops, smaller facilities. So the industry across the country is extremely fragmented. As a result, it's very difficult to get good data on. Generally speaking, we see them selling at multiples of 4 and 6x for EBITDA. And most of these transactions, though, are health systems, acquiring the single modality institution, tucking it into their system, or creating some sort of joint venture with them where they're not doing a full acquisition, but there is some sort of partial ownership joint venture arrangement to bring them into the fold. Two of the things that are creating headwinds, I believe, is, in 2022, there was a study that was performed on 50 of the most common imaging studies in diagnostic radiology. And they experienced a combined reduction of payments of over 44% from 2011 to 2021. So you're seeing reimbursements cut almost in half for the most commonly used testing. The other thing that's having a chilling effect is the regulatory environment. Regulations that were proposed and adopted in the last couple of years have made the regulatory system that they operate in incredibly complicated, incredibly risky, and very challenging to navigate without a lot of resources. That's why you're seeing these single modality facilities get tucked in, is because they no longer have the resources to be completely compliant or fight challenges along the way. One really interesting thing, and the reason why I included it in here, to keep an eye on, is this summer, the Supreme Court struck down something called Chevron deference, which basically is going to have a big limiting effect on government agencies adopting rules. It's really going to push that decision to the courts. And so some of the regulatory environment in these healthcare industries could see a very dramatic shift as different systems challenge rules and interpretations CMS, HHS, and OIG have adopted and tried to enforce. So that's why I put it in here. Okay, that's a quick overview of these three different areas in the healthcare industry. Now, you know the market. I want to talk about just a couple of examples, okay, using the EBITDA methodology, because I think it's really important to see a visual representation of just how vital and how critical those two factors, EBITDA and your multiple, are in creating value for you as a seller. Right? All right. First one, we're going to look at an increase in your EBITDA multiple. So I've gone ahead and controlled for EBITDA, right? Net profit at $1.3 million. This graph shows an increase in multiples across the horizontal and across the bottom. And in the vertical is the sale price. And just for good reference, right here's the median multiple for a physician medical group, okay? I think this is a good place to start. If you are looking at a 5.5 multiple on 1.3 EBITDA, your purchase price is $7.15 million, okay? By moving it up just a half a multiple to 6, you realize a 7.7 to 9.1% increase in the value of your practice or facility, which translates roughly into about $650,000 to your bottom line, right? That is value that you otherwise would not have captured, right? As your EBITDA goes up, for example, 3 million, then that gap widens, right? $3 million EBITDA, the difference between a 5.5 and a 6 multiple is $1.5 million. So as a seller, you should be doing everything in your power to command a higher multiple. We're going to get into ways of doing that next. All right, last one, last example. This is increasing your EBITDA. So that's moving from 1.3 to 1.45 to 1.6, right? And assuming that your multiple doesn't change, stays at 5.8. Okay? Well, here you can see increasing your net profit, your EBITDA, by $150,000 translates into an increase of your purchase price of $850,000. Okay. That is why it's so critical to focus on these two elements before you go to market, because positioning yourself to command the highest multiple with the leanest operations, so the most profitable operations, is going to translate into huge returns on your investment, on your time, on your practice and facility. So I don't need to hammer that too hard, but I'll give you a quick example. A client of mine who's on the private equity side is looking to buy a couple of healthcare facilities. They have a profit margin of 50%. Okay, so the multiple I think they're getting is 8.3 at the moment. The difference between a 50% margin and a 30% margin is translating into $40 million difference of enterprise value. Right? Matters. All right, so how do we get there? Steps 2 and 3, these have the largest impact on the multiple you will receive. Okay. Step 4 is going to be focused on improving EBITDA, but steps 2 and 3 is about getting a better multiple. How do we do this? Well, step 2 is about enhancing your internal documentation, controls, and reporting. Why does this matter? Well, first thing you do in the acquisition process is you sign an LOI and immediately start due diligence. And the things your buyer is going to ask for are your documents, your processes, your procedures, your financial statements, your metrics, all of this, right? And that's what they're going to use to base their valuation of your company, the multiple, on. So documentation, what does that look like? That's, do you have your vendor and third-party contracts in place, your marketing agreements, your IP licenses, your leases and subleases? Do you have copies of all of them? Right? Do you have employee handbooks? Right? Do you have your HR files? Are they all centrally located? Do you have your employment contracts? If you have any, most of you probably have at-will employees. That's fine. But a lot of your professionals probably have employment contracts. Do you have copies of those? Right? Do you have a copy of payer contracts if you're a participating provider or in-network facility? Right? You want copies of those. And then one of the biggest challenges I think a lot of providers face is, do you have consolidated patient and reimbursement data? That means, is it all centrally located? Is it easy to access? Or is it stored in some legacy systems? Is it on someone's hard drive in one location and in the cloud somewhere else? Or is it in a bunch of boxes stuffed away in a storage facility, right? I've seen all of it. And so the easier you make access to this information, the cleaner it is, right? The less things that are missing, the more attractive you become as a target. Right. Let's talk about controls. Okay, these are your policies and procedures, right? Similar to your handbook, but do you have EOC policies? Do you have harassment policies, retaliation policies, hostile work environment, employee fraternization policies? Are all of these things documented and in place at your practice? Okay. Have you clearly defined management roles and responsibilities, like reporting lines and things like that? What is your chart and claim quality assurance processes? Do you perform audits, right? Do you have someone else, a third party, reviewing claims before they get submitted? Do you have someone comparing the claims to the charts to make sure that your diagnoses are accurate, that your charts are complete, right? What are those processes in place? Chances are you have most of them, you just haven't documented them. And so reducing them to paper to standardize them is a great way to show a potential buyer that you have everything in order, you're a well-oiled machine and command a higher multiple. Last thing on here is your reporting, right? What are your key performance indicators, your key risk indicators? How are your financial statements looking? What type of information are you using to make business decisions for your practice? For example, do you know what the average reimbursement is for your most commonly used CPT codes? And do you know how it changes based on the payer? Do you have all that information? Do you know what your patient mix is? Do you know what your average patient encounter per day is? All of these things are metrics that you can be tracking and reporting up for making decisions on marketing, staffing, expenses to cut, additional services, automation. Do you need to upgrade your EMR, right? So having these reporting processes in place is also a signal to the buyer that you are sophisticated. You're going to be an easy transition, right? If you have all three of these elements properly documented, recorded, and clean, easy to access, easy to understand, it's telling the buyer that this is going to be very easy for them to take over and continue on the success that you've built, which is what you want. All right. Step 3, resolving compliance and legal risks. This is potentially the area that could have the largest negative impact on your multiple. And depending on what gets uncovered during due diligence, it may cause a buyer to walk away altogether, which would be the worst case situation. So we're going to talk about, laws around fraud, abuse, and the corporate practice of medicine. Those are honestly very complex, nuanced regulations and laws that healthcare practices and facilities face that other industries just don't have to. It's also one of the most commonly violated set of laws for practitioners. And like I said, it can have dramatic effects, not only on your practice, right? Forget about the M&A process, but especially in the M&A process, right? They uncover something that you didn't know about. It's most likely going to make the buyer walk away, or they're going to offer you pennies on the dollars from what they would have before. So, things that require an analysis and sort of a sign off on compliance and understanding, I think, before you go to market are things around the Anti-Kickback Statute, Stark Law, False Claims Act, No Surprise Act, all the state analogs, right? And the types of documents and arrangements that would trigger violations under those laws. So we're talking about lease, sublease arrangements, contractor agreements, marketing, billing, and management service contracts, patient intake and disclosure forms, what your collection process looks like, things like that. Cleaning all of that up before you go to market, but especially before you enter the due diligence phase, is critical to commanding a high multiple. These other ones are a little more self-explanatory, right? Do you currently have open, ongoing, or threatened audits? Are you in prepayment review? Have you received notices from an SIU department that they're investigating your claims? Do you have any pending lawsuits, right? Whether it's medical malpractice or slip and fall, right? Or employee wrongful termination claims or threats. Anything like that that could cause a red flag. Or if you have incidents that should be or have been reported to the National Practitioner Data Bank, all of these things happen, right? So it's not necessarily a matter of making sure that they never happen, which is something I try to do with my clients. But if it does occur, it's more important to be aware of it, to attempt to address it, and have a plan on how to mitigate that risk. That's really what a buyer is looking for. They want to know that they're not going to get blindsided and that they can just take over a plan of action rather than having to develop a whole new solution to rectify an issue. All right. Again, that sort of wraps up our two areas that we talk about that impact your multiple. They take time to address, right? These aren't changes that you can make in a week. They aren't changes you can make in a month. A lot of times it takes a year, 18 months of preparation and work to address these things. And that's what it takes a lot of times to fetch the highest multiple. All right, we'll move into step 4, which is improve margins. Seems easy, right? just make your practice or facility more profitable. Well, we'll get into that just a little bit, provide a little more guidance here, but there's 3 primary areas I think that can be targeted for improving margins, right? Obviously, if you increase revenue by doing a reimbursement analysis, that's a clear way of doing it. Increase your revenue without increasing your expenses. Pretty self-explanatory, but one way you can do that, right? Analyze the rates for your most commonly used CPT codes, see if there's been any changes in them, up, down, whatever it is. Look at your AR. How effective is your collections process? Are you collecting all the copays and co-insurance that you should? That's a regulatory issue, but it's also a business issue. Are you exploring opportunities for avoiding reimbursement compression, right? Are you looking for new techniques, right, that yield better results for your patients, but also command higher reimbursement? That could be another way. The last point here, participating provider payer contract negotiations. Unless you're already a practice or a facility with considerable size and volume, you're not going to get a great rate from commercial payers. So this may not be something I would invest a ton of time and energy in right away. I'm going to jump down to the bottom and talk about third-party services. So a lot of times as you're operating your practice, you start accumulating services, licenses, fees, all kinds of things. So without actually utilizing them. So doing a very in-depth analysis of those recurring payments, whether they're licenses, contracts, whatever it is, and terminating the ones that are no longer useful is a great way to increase your margins and create a lean operating entity going forward. One thing to keep in mind is, I'm sure you're thinking about this. Well, okay, I hire a lawyer, I hire a consultant, whatever it is. That's an expense, right? Doesn't that impact my EBITDA? So if they just look at historical EBITDA, the answer is yes, it will. But like I was saying before, most of the time you're going to get an adjusted EBITDA that would remove these one-time expenditures, especially if they're going to improve efficiency and get that money added back into EBITDA. So there is that advantage, right, of undertaking the expense now, rather than just letting the buyer deal with it and dinging you on the sale price. All right, the last one is the provider compensation, right? So this is going to be highly specialized to your practice, whether you're a single physician or provider practice, or you have multiple providers, shifting your compensation structure from away from maybe a high guaranteed salary to more of a performance-based or productivity-based comp structure can help improve your EBITDA, because the contingent comp is, or excuse me, the performance comp is contingent. And a lot of times you can argue to have that added back in, versus a high fixed salary is not. So that might be worth either bringing up to, partners that you have, other physician employees or provider employees, or if you're a solo, something that you can implement pretty quickly. The other part of that is, where appropriate, using mid-levels, NPs, PAs, whatever it is, to reduce your overhead, especially the salary component, even if it's just for the year or 18 months leading up to a sale, could be also another way to improve your EBITDA. All right, last step, and this is often overlooked, but is incredibly critical to the success of the transaction, also the success of you, right, after you sell your practice. And that is defining your post-transaction success criteria. Right? It's a mouthful, but essentially what it means is, what is your objective in selling? Why are you doing it, right? Are you trying to alleviate the administrative and management burden, right, of trying to grow and maintain a practice? A lot of people are. Are you looking to exit medicine altogether? Right? Are you relocating? Are you just trying to cash out on years of hard work, but want to continue practicing? Or are you trying to join a growing venture, right, where you want to be part of a larger system or a more growth-centric system, and you want to be able to participate, right, in the upside? Each of these objectives is going to impact how we structure a transaction and what you look for and value higher, right? For cash, equity, productivity bonuses, whatever it is. So knowing that before you go to market is important. And I counsel clients all the time on what life looks like after sale. Because a lot of times I find that my clients that have sold their practices find out that they don't want to work for a large company, right? And so they actually aren't very satisfied after the sale. The sale price was a nice big boost, but they were young in their career. They may have been in their 40s. And so they don't really know what they're going to do for the next 20 years. They can't continue to practice medicine in that location, at least not for a period of time. And so, it may not have been a great fit. I have other clients that couldn't wait to exit. They wanted to start a new endeavor. They wanted to go a different direction. They wanted to be entrepreneurs. And so this provided seed capital for that type of lifestyle and business venture. So it was a great fit. And yet another client who actually sold their practice, an internist, sold their practice to Summit, and rather than take a large upfront cash payment, actually took equity in Summit. And as a result, over 5 years, quadrupled, right, the value of that equity, right? It just depends on what you're trying to do. He took an administrative position within Summit. So knowing what your goals are is critical. And I can help evaluate those goals with you. I can help talk about different alternatives and structures for achieving them. But you'll never know unless you ask the questions and you sort of dig into it. All right, so just real quick, what does this look like? Most common examples of this are, your salary plus a productivity bonus or rollover equity. Strategic buyers are more likely going to do a salary with some sort of productivity bonus based on metrics that are established at the closing of the sale. So basically, if you don't achieve the metrics, you don't get the full compensation you would have been entitled to under the purchase agreement. Sometimes that's structured as a holdback, right? Where you just have to achieve the metrics and they release cash that's in escrow. Other times it's structured as a bonus. There's pros and cons to both, but that happens usually in strategic buyers. Not as much in private equity. Private equity likes having the rollover equity because, again, they're looking to, once they acquire your practice or facility, they're looking to sell it in 3 to 5 years. So they would rather roll part of the purchase price into equity of the buyer so that you're aligned with management. And when they sell, you get the bonus as well, right? You get the bump, but you stay invested in making sure that the practice you just sold to them continues to operate at a high level and remain extremely productive. Last part of this, restrictive covenants. Keep in mind that, a lot of you probably heard about the new FTC rule. Even if it is implemented, which is highly unlikely, won't affect people selling a practice. You're still allowed to have a non-compete lock you up for 5 years after the sale. Could change if you have an employment agreement after the sale. That's a detail we can talk about later. But most likely, you're also going to have a 2 to 5 year lockup period where you have to be employed after the sale. So just keep all these things in mind as you're weighing your options. All right, that was step 5. So in closing, right, a couple of key things to remember. Don't leave money on the table. Your multiple and your EBITDA work together to create enterprise value. If you just focus on margins and don't correct the things in step 2, documentation, legal and compliance risks, your multiple is going to tank and you won't get the value that you deserve, right? If you just focus on multiple and run up expenses, right, that's also going to have a negative impact on your valuation. So the two need to be taken together. Don't wait, right? Don't wait. You cannot do this in a month. Not only can you not do it in a month, but your buyer is going to look at P&Ls for the last 12, 24, 36 months. So even if you had one great month, it's not going to matter because they're going to normalize it over 3 and then do their evaluation that way, right? It's going to be viewed as an anomaly. So you really want 12 months of clean looking P&Ls that show this growth, show the strong profit margins. And then lastly, know what your objectives are with the sale. Okay, because if you don't know what those objectives are and this transaction won't help you get closer to them, you won't be satisfied at the end of the sale. All right, so at that, here's a little breakdown of me. Like I said, I'm Trevor Anderson, managing partner at the Anderson firm. I've got 10 years of experience working in healthcare before that, healthcare and law. Before that, I was a consultant at Ernst & Young, working with multi-billion-dollar banks. And I bring these two services together to counsel my clients through these types of processes. We also provide a lot of corporate work and regulatory compliance work. And so what we do is we really work as outside general counsel for a lot of our healthcare clients to provide a full suite of guidance, legal support, services, you name it. I'm also a big hiker, so if you ever want to go hiking in the Northeast, let me know. All right, with that, I'm going to take a look at the Q&A and answer a few questions. All right, so one of the questions that we asked is, what's the difference in a multiple when selling a medical practice versus a surgery center? That's a great question. So historically, the multiple in the surgery center has been a bit higher than the multiple in the medical practice. Reason being is that the revenue is a bit more predictable. It's a bit easier to standardize operations in one surgery center for multiple surgery centers. So usually the PE firm or whoever who's buying the surgery center already has several in their portfolio. And so they've got a system that they're bringing it into, and they can realize more gain as a result of that. So they pay a higher multiple. It's not a fixed ratio. It could be anywhere to 1 or 2 points higher. But again, it depends on the size of the medical group, right? The more EBITDA they have, the higher the multiple they're going to get. I've got a question here about, can I explain rollover equity a bit more? Absolutely. So as the seller, you are selling your entire practice, generally speaking, to the buyer. And when that happens, the buyer is usually going to close down that seller entity, right? They're going to fold it into Summit. They're going to rebrand it. They're going to do whatever it is. And it's going to be a brand new entity that is holding that business. Rollover equity is saying, hey, listen, if the purchase price was $10 million, we're going to take $1 million of that and convert that into $1 million worth of equity in the buyer. So now you have $1 million stake in the buyer plus the $9 million in cash or whatever it was that they paid at closing. And so that can be a really great opportunity if you think that the buyer is going to grow, right? If you think that your investment in them is going to grow. So if rollover equity is part of the comp structure or the purchase price, you're also going to be doing due diligence on the buyer, right? Because you want to make sure that if you're going to bet $1 million or $2 million or whatever it is and not get that in cash, if you're going to bet that on the buyer, you want to make sure that it's a sound investment. Let's see here. Let me look at a couple of other questions. ASCs and the market in New Jersey. So New Jersey and a few other states are a bit different. It's a very fragmented industry. And one of the reasons is there's a certificate of need and a few other elements in the Department of Health that makes it very difficult to open an ASC. Other states don't have that. Texas, for example, there's no certificate of need, and so you're able to open these facilities a little bit easier. So as a result, the consolidation of ASCs in New Jersey is not as vast as it is in other jurisdictions. So on one hand, that means that you're probably not selling it to a strategic acquirer. You're probably selling it to a private equity fund who's structured a management arrangement, right, with the facility. But it also means that the data on it is really siloed. So you could be at a disadvantage for negotiating your multiple because there's not a lot of examples in New Jersey, and it's not going to be public information. So that's why it's really important to have a great advocate on your side to really negotiate strong and hit those elements that we talked about in steps 2 and 3 to drive the multiple up. All right. Well, everyone, I really appreciate you joining us on this Thursday evening, taking some time out of your evening. It's a pleasure having you again, Trevor Anderson at the Anderson firm. I'm happy to answer any questions that you have on this presentation, but also in any of the other industries that we talked about. If I don't have the right answer, I always try to put you in contact with the person who does. With that, thanks. I appreciate it, everyone.